Inflation goes sideways, mortgage rates go sideways. Inflation bumps up, mortgage rates bump up. And then you have the recession, which occurred in January of 2020. And then you have the COVID situation, which caused the Fed to step in and do quantitative easing, or QE. So they started buying a tremendous amount of mortgage-backed securities. And by doing that, they, in essence, fixed the mortgage market at 3%. And you can see that here. It's 3% on your left. And notice that the Fed kind of kept mortgage rates at 3% by buying enough mortgage bonds. Now, Fed didn't do that with interest rates. They did that with physically buying mortgage bonds. So as the Fed kept mortgage rates in this range here, that was kind of okay when inflation was low. But something started to happen. Inflation started to move up rapidly. The Fed said, don't worry about it. It's transitory. Because unfortunately, the Fed looks at data that's old data. It's kind of like driving your car down the road while looking in the rearview mirror. You don't get things right very often. So inflation starts moving up. They ignore it. Finally, they wake up and they see that inflation's a problem. But by the time that they do this and stop buying mortgage bonds, inflation had really gotten way out of control. Now, once they stopped buying mortgage bonds and fixing and rigging the system, well, mortgage bonds did what they always do. They follow inflation. So when inflation was rising, mortgage rates were rising. In the spring, when inflation actually took a dip, mortgage rates took a dip. Then inflation takes off, mortgage rates take off. And since November 10th, as inflation showed signs of coming down, mortgage rates have come down. It couldn't be any clearer than this, folks. So we talked a lot about inflation driving mortgage rates. Maybe we'll take the first step here and say, okay, so what's inflation? Well, the best way to think about inflation is it's simply too many dollars chasing too few goods. Look, in the real estate market, too many buyers that had dollars because they can get loans were chasing too little inventory, and that caused prices in homes to go up. House inflation. You remember during COVID, you couldn't get toilet paper? Well, what would you pay for that? Too many people need it. There wasn't enough available. Prices went crazy. So it's like that with anything. Too many dollars chasing too few goods. So what is the Fed trying to do when they try and curb inflation? They want to pull less dollars. Now, when you think about dollars or money, for every $17 of money, did you know that about $16 of it is credit? Our country really runs on credit. Think about it this way. A family goes to purchase a car. And let's just go back 8 or 9 months ago. They went to the dealership. They look at a nice car. It's a $60,000 car. They say, okay, I'll buy it. How much is the payment? $600 a month. Well, they just sign a piece of paper and walk off. Where did the money come from? At a bank, someone made a few keystroke entries and poof, out of thin air, $60,000 was created. So more money was created. That's kind of inflationary, right? That's provided because rates were very low. Now, as the Fed's been hiking and hiking and hiking, now car loans, which are directly affected by Fed rate hikes, are much more expensive. So if that family were to now instead look today at that car, that same $60,000 car, instead of a $600 a month payment, the payment might be $1,000 a month. And you know what that family says? Well, maybe I'll drive the car, have a little longer. So there's no poof, somebody at a keyboard at a bank creates an extra $60,000. That never happens. So what the Fed is doing is being successful in reducing the amount of money, reducing the money supply by tightening credit. That's what tightening credit means. Now, that's for families. What about businesses? Imagine a business wants to invest or acquire another company, or maybe build a factory or expand. And these are big monies. So maybe they're going to do it for $500 million. They're going to build a factory. Well, when the Fed funds rate was at 0, and maybe they're paying 2% above that, it might make sense economically to take out that loan for $500 million. But now that the Fed's hiked so much, and they're going to hike again on the 14th of this month, in just a little bit over a week here, or maybe it is exactly a week. So what'll happen is a week from tomorrow, forgive me, is that you're going to see, instead of it costing them maybe 2% above 0, now it might cost them 6.5% or something like that. And maybe on $500 million, the additional cost doesn't make sense. So guess what? They don't do it. And there's no extra $500 million in the economy. So by the Fed hiking rates, it slows borrowing. And you know what else happens? People now see that they can get a return on savings. Heck, you could buy something like a 6-month or a 1-year treasury or 2-year treasury and get like 5%. 8 months ago, you were getting a fraction of 1%, less than 1/4% for these things. So today you can actually, before when you get no money for saving it, people spent it instead of saved it. Well, today people are saving a lot of that money instead of spending it. And that's taking money out of the system. That's reducing inflation. But something else is happening at the same time is that supply chain is finally coming back and inventory levels are coming back. In fact, if you look at inventory levels, you could see they have skyrocketed here. We had obviously COVID and the supply chain was broken. It started to come back and then China shut down, but we've worked through that. And now shelves are stocked with goods. And folks, you tell me, what happens when you have shelves stocked with an overabundance of goods? They go on sale. And when they go on sale, that's a reduction of price, lower prices, lower inflation, right? That's more goods than dollars. So it brings prices down. I mean, look, you probably witnessed it. Look in your inbox, right? How many sales are you seeing? It's Cyber Monday, Cyber Tuesday, Cyber every day, right? They're still doing Black Friday sales, 2 weeks later. So we know that there's an abundance of goods, and that means prices are going to keep coming down. Now, when we talk about inflation, how do we measure it? Well, a common measure of inflation is the Consumer Price Index. Now, the Consumer Price Index, when you look at that overall number, the headline number, that includes food prices and energy prices. But those prices are oftentimes going to be determined by things like weather with food or pipeline disruptions or OPEC output for oil or energy. So when the Fed says, hey, when we want to look at inflation, let's look at things that we can have influence over, food and energy. We don't going to have influence because we can raise or lower rates. It's not going to change the weather or what OPEC does. So the Fed looks at something called the core rate, which takes out food and energy prices. Now, right now, that number is 6.3% year over year. So that means compared to last year, on the core rate, things cost 6.3% more. That's a lot more than the Fed wants. When you think about compounding of this, something like this means that prices would double in something like 11 years or so. That's way too fast for prices to double. So when you figure out how did they get to the 6.3, you can take a look at each individual month, starting with the most recent data we received, which was for the month of October of 2022. And if you count the 12 months leading back to November of 2021, if you added these together and account for a little rounding and compounding, you get the 6.3. So that's how you get there. Now, we've been doing a very good job of forecasting this, and a lot of people miss it because they don't understand this. I'm showing you something that the vast, vast, vast majority of people don't understand, even admittedly our own Fed, when you have our Fed chair a few months ago saying, we now understand how little we understand about inflation. They don't understand this. So you're going to understand more than they do. Now, back in the spring, in June, everybody was talking about inflation peaking. In June of 2022, we said, no, they're all wrong. Well, how did we know that? While everybody said rates are going to come down and inflation's peaking, we said, no, it's going to be a brutal summer. We use the song Cruel, Cool Summer. If you watch our updates, we told everybody you're going to have a lot of heartburn over the summer, and we warned of higher rates coming. So how did we know? I'll show you. Because when the June numbers for 2022 came out, it was 0.7%. It replaced June of 2021 over here. So 0.7 replacing 0.8, it caused inflation to drop on a year-over-year basis. And people said, oh, inflation's peaking, it's going to come down, things are going to be great. That wasn't the case. How did we know that? Because if you looked forward and you said, okay, the new numbers that were going to be coming out, we didn't think that what the Fed's actions were, which they just started to get serious about rate hikes with the June 15th hike, that was the first 75 basis point hike, that it would take effect that quickly. It takes a few months, 2-3 months, till it starts to take it. We didn't think it would start to hit until like October. And then we looked and we said, well, as the new numbers come out for July, August, and September of 2022, they were going to replace the numbers for 2021. Now, do you see something here for the numbers of 2021? These numbers were very what, everybody? They were very low. So there was a really good chance that higher inflation numbers were going to replace lower inflation numbers, and that was going to make the year-over-year numbers go up, which means if inflation goes up, what do mortgage rates do? They were going to go up. And that's why we were forecasting bad mortgage rates over the summer. And that's exactly what happened. Because as July, August, and September came out, replacing these low numbers with higher numbers, inflation on a year-over-year basis went from the mid-5s to the mid-6s, and mortgage rates did what they always do. They went up also by a little over 1%. Then we said the date that you want to circle on your calendar, and I've been saying this since June, 4 months in advance, was November 10th. Why? Because that was the date that we were going to get the data for October of 2022 on November 10th. That was going to replace October of 2021. And what we said is by then, you will start to see those inflation numbers start to cool because of all the Fed actions and the supply chain being fixed. But when you look back, it was now going to start replacing more elevated numbers for 2021. And sure enough, that's what happened. And you all know what happened on November 10th. We had a 206 basis point rally that we had called in advance. But then we also said, hey, as other inflation numbers come out, you will continue to see a rally. And that's what you're starting to see here. So as new numbers come out, and the next one's going to be December 13th, you'll get November of 2022. That's going to replace November 21. There's a good chance that we will see a continued decline. But what's keeping the numbers that are coming out a little elevated are shelter costs. You see, shelter is a lagging indicator, and shelter is the cost of a roof over your head. It makes up 39.3% of that core CPI that you just looked at. So it's got a pretty big influence over it. And in real time, look what's happening to shelter costs. They're not dropping, but they're decelerating. This is still a positive number. They're still going up, but much less than they were. Now, in the real world, this is where we are. But the way that the Fed looks at it in CPI, the way it measures it, remember, it's looking at 12 months. So it's taking all of this into consideration. So the number that's being influenced on CPI is a high number until eventually we get through it. Remember when you were a kid, you went on a roller coaster, you go up that first initial big hill to get that inertia down. Well, there comes a point in time where the front of the roller coaster is heading down, but the back of the roller coaster is still moving up. And that's like the way that CPI is. The shelter costs in real world are heading lower. And you just saw it, right? Look, you just saw it here. This is in the real world. But the way that the Fed looks at it in CPI is it appears to be going up. So 39% of that CPI is still being influenced higher. Now, the peak will be January. Once we get past January, we get that data in February. After that, the readings that we will get for February, starting like with the March reading, you'll have all of this inflation from shelter heading down. And so the inflation reading on CPI will start to move lower faster. And what does that mean? Mortgage rates will accelerate to the downside. Now, if you take a look at money supply for the first time is actually negative by this degree in like 60 years. And if you take a look at where we are in money supply, it has declined for the first time in over 60 years. It's the first time you get negative money supply. So what is inflation? Too many dollars chasing too few products. We are now in a position where you're seeing less dollars because of all the reasons I talked to you about. So how does this impact mortgage rates, and what would our forecast for mortgage rates be? Well, I've been pretty bold in giving you where we're going to go, and I'll have no problem telling you why I think mortgage rates are going to reach the level that I'm about to tell you and when they should hit there. But let's understand a little history first. So this is something we did that nobody else does. And we looked at a 35 years worth of data in history between the 10-year treasury on the bottom and mortgage rates. Now, this is 35 years on one sheet. So for sure, day to day, they don't follow each other. They're not in lockstep. But over a period of time, I think you can clearly see that there's a pattern. And mortgage rates are higher than the 10-year treasury, typically by about 1 3/4 to 2%, or in basis points, 175 to 200 basis points. And all of these red arrows are of equal size. So you can see that's been the case for a while. So, you know, if the 10-year treasury is at 4, well, mortgage rate should be around 6. And you could see that. If it's around 5, mortgage rate should be around 7. So you could see this over and over and over again throughout a 35-year history. But today we have something we've never seen before. It was just recently when the 10-year treasury was at 4, mortgage rates were at 7. Now that's a 300 basis points or 3% spread. Well, what the heck happened here? It's supposed to be between 175 and 200. What happened? You have to understand the way a mortgage works. And those of you that are CMA graduates, you understand this and you know this, that no one holds a mortgage and why and what happens. And rather than give you the whole background, just understand that mortgages are risky, not because of repayment, but because of interest rate fluctuations. So no one wants to hold that hot potato. As it gets sold and no one wants to hold it, someone still has to be there to make the collection of payments, to pay the taxes, to track you down if you're late and send you a nasty note, to answer your questions, give you your payoff balance. Someone has to service your mortgage. Well, that's called a servicer. So servicing has a value. Now you get paid for that. So the servicer would get a fee for servicing the mortgage. And that fee, it's kind of easy to figure out. If you say, well, you're going to get paid this fee every month for doing the work on it, and you're going to, if you are estimated to keep this for X amount of years, you take the fee per month times the month you're estimated to have it. That's the value of servicing. So pretty easy to calculate. The more value that's in a mortgage, the better the price, the lower the rate. You know that from your rate sheet, right? So the better the price, the lower the rate. The worse the price, the higher the rate. So what you see in the current market is you see the smartest minds in the world are agreeing with us here. They're agreeing with what Dan and I have been saying early on, that rates have to come down. And as rates come down, what's going to happen to those 7% mortgages? They're not going to be around for a while. They're all going to get refinanced or paid off, which means you're not going to collect your servicing fee for a long time. So it's not measured in years, it's measured in months, which means all the servicing value has been sucked out of it, which reduces the price. When the price gets reduced on mortgages, the rate goes up. And that's where we are today, or we were today. We were at a 300 basis point spread. And what we had been saying since we've been showing this chart is we said, we know that the 10-year treasury is going to come down. And our forecast was the 10-year treasury goes to 3. Now, we made that call when it was at 4.3. And everybody said, Barry, what are you freaking nuts? Everybody said that. Everybody, Housing Wire saying it's going to go up. All these, everybody said it's going to go up. It's going to go. You watch CNBC, Patrick Bet David, it's going to go to 10% mortgage rates. We said, no, 10-year treasury is going to come down. And we said 3%. Everybody thought we were crazy. Well, it's gone from 4.3 to now what? 3.5 in 26 days. So we'll get to 3%. But what we said was as the 10-year treasury comes down, mortgage rates will come down faster. Why? Because lower mortgage rates have a greater servicing value. A 6% mortgage has more servicing value than a 7, a 5 more than a 6. So the lower rates come down on the 10-year, the faster. They're not going to be proportionate. Mortgage rates will come down faster and narrow the spread. And here's what's happened since we said that. Because here, if you look at history, history shows that if we get down to 3%, like we said, mortgage rates, where were they when rates were 3% historically? When rates on the 10-year was 3%, mortgage rates were at 5%. And now, if you take a look at the current spread, it's gone from 300 basis points to 280 as the 10-year treasury has come down. So we're going to continue to move lower, not in a straight line in the first quarter, and we're going to move towards a rate of 5% on mortgages. And when that happens, you're going to unleash a horde of borrowers on the marketplace. Now, there's also a recession that's going to happen. Savings rates are dropping. All the yield spreads are inverted. And people are delaying it. Why? Because they're literally living off their credit cards. What's keeping us afloat is living off credit cards. You could see before the last recession, and then obviously stimulus money. And here we are. And savings rates are dwindling too. So people are living off savings, living off credit cards to keep their lifestyle. Eventually that well runs dry. So why do we talk about recessions? Because mortgage rates do well during recessions. Take a look at the last several recessions. Mortgage rates dropped 1%. Mortgage rates dropped more than 1, a little more, less than 1. But each instance, it went down further than when it was the recession. Here, 2%, then more, 5%, then more, 4%. Team, rates go down during recessions because recessions slow the economy and it slows inflation. So when we take a look at these moves, and we know there's a recession coming, if we're not in it already, Can mortgage rates come down? People were saying, can rates come down? Really, 2%? They thought it was nuts. Well, we've already got halfway there, right? Rates have already come down from 7.25% to like 6.25%. Can they get to 5.25% over the next 6 months? Absolutely. It might be a lot sooner. By the end of the first quarter, as we have forecast, mortgage rates should be around 5%. By the end of the second quarter, maybe they'd be under 5%. So if we do hit a recession, is that bad for home prices? No. Let's get the facts straight because the media will get it wrong. During the last 9 recessions, home values have gone up during and after the recession 8 out of 9 times. What happened here? The recession came after the housing bubble. There was a housing bubble here, not a housing bubble because prices went up. And a big difference between then and now is the type of product. So you have no income, no asset, no job, no down payment, 580 FICO score. Come on, fog up a mirror kind of loans. We don't have that today. So it was built on, but on straw here. But yet there's a more deep-rooted reason why there was a housing bubble. And it goes to the basics of supply and demand. There were too many homes, not enough households being formed. That's how you measure supply and demand in housing. So let's first talk about how you measure supply. That's builders building a home and completing it so that you can move into it. That's extra inventory. Demand is a household formation. What's a household formation? Okay, imagine mom, dad, and a child. They're living in a household. Now, at some point in time, that child reaches an age, in the United States, on average, it's age 33, that they move out and get their own place. So now you still have mom, dad, and a child, but instead of one household, they have 2. So they have formed a household. And that's how you get household formations measured in the United States. When you have, like on this chart, the gold bars, that's builders completing homes. The blue bars are household formations. And notice in the early 2000s, it was pretty close. And even if the gold bars are a little higher, that's okay if they're a little bit higher because every year about 100,000 homes due to aging get replaced or retired. Now, 2006, something crazy happened here. So builders built more homes than they ever built in our history, even till today, nothing close to it. And yet, household formations dropped off a cliff, then dropped again, stayed low before recovering. So this imbalance of too many homes and not enough buyers or households being formed caused the housing bubble, compounded, of course, with the fog up your mirror products. So when we look at this and people say there's a housing bubble today, well, this is what caused it. We know we don't have the programs, those crazy fog up a mirror ones, but can this happen again? It's important, right? Because what if this happens again? We should have a housing bubble, right? Well, let's see. What caused household formations to drop so rapidly? Could it be, if these are your 33-year-olds moving out, that maybe there were few of them born 33 years before? Well, let's look. This was 2006. So 33 years before 2006 is 1973. Fortunately, we could see how many people were born in comparison in 1973. And isn't that amazing? There was a big drop in births in 1973. So wait a minute. We got a big drop, another drop, stays low, and then starts to go up. Hold on a second. Big drop, another drop, stays low, and starts to go up. It's like an exact match. Well, it has to be, because the people that were born here wound up becoming 33-year-olds here and moving out and getting their own place. Now, why did we have this big drop, and can it happen again? Well, this was caused by abortions being legalized in 1973. Now, listen, I'm not saying for, I'm not saying against, I'm just giving you the reason why, okay? Abortions were legalized, less people were born as a result. Now, could this happen again? Well, let's take a look at 33 years ago. Look at the number of births, much higher than back here. And in fact, they went up and up and up. So these are your 31, 30, 29, 28-year-olds that are yet to get their own place. So there's going to be even more demand in the future, folks. And if you want to know why the housing market's been so strong, look no further than this. Too many households being formed and builders not putting enough homes up. Now, you can't blame builders because they've been burnt by this lesson. Now, how many households are being formed in the United States today? We've been averaging about 1.7 million households being formed, about that. But of late, the last couple of months, it's dropped to 1.3. That's an exact response to mortgage rates being 7%. People are hibernating. They're waiting. They're saying, wait, I was going to buy a house, but at 7%, I'm sticking with mom and dad a little longer. But that's not going to last forever. When rates come down, this will go back up. This will go back up to 1.7. At the same time, builders are only completing 1.4. And remember, 100,000 homes get retired annually or destroyed annually. So right now, you've got a balanced market, which is why you're not seeing huge price declines, maybe a little bit. Month over month, prices went down 0.1%. I mean, it's not a huge decline, not exactly the 25% drop we've seen in home prices during the housing bubble. But what people are not looking at is that when rates drop, these household formations will go up, and that will support prices and likely push prices higher. But the media, meanwhile, is going to try and scare people and keep them at bay. You've got people, like I said, Patrick Bet-David, who's been putting out a lot of material on it. You've got things in Housing Wire that you see. You've got things that you would see all over, including CNBC, Grant Cardone, everybody talking about a housing bubble, don't buy a home. And Diana Olick is doing this like 3 times a day, and she's been doing it for 10 years, or 8 years rather. Now, she has put out literally, not exaggerating here, hundreds and hundreds of negative stories about housing consistently. She's never put out a good one in the last 8 years. She's been dead wrong. Unfortunately, we can look back at her track record here and you could do this too, just go to the internet. Here's a couple of highlight reels from her. In 2015, so now we're going back now a little more than 7 years ago, she said, we're in a bubble larger than 2006. Well, home values have done nothing but go up since then. And a $300,000 purchase price, if you didn't do it, in that 1 year, it went up $15,000 or 5.1%. The next year, she didn't offer an apology. She just said, hey, we're in a new housing bubble. So it's rinse and repeat, same story. The next year, homeownership does not build wealth. Well, can someone show me one person in the last 5+ years who didn't build wealth in housing? Categorically wrong. And of course, prices went up that year. Then the next year, she says, hey, it's better to rent than to buy. Well, please show me the one person who said, I'm so glad I didn't buy a home 4+ years ago and I rented. So show me the one person. So she's categorically wrong again. In the middle of 2019, CNBC did a whole story, a feature. Don't buy a home until you hear Diana Olick's analysis. So you waited the 2 days until this big thing came out, and she said that the housing market's about to shift in a bad way. What a surprise. Did it shift in a bad way? No, values went up again. And at the end of 2019, she put out her forecast for 2020. Guess what? Yeah, next year is going to be hard on the housing market. Well, it was only hard if you didn't buy a home, because values went up the next year $61,000 or 16%. And then she said this now a year and a half ago. The housing boom is over as new home sales fall to pandemic low. Since then, values are up 18%. In the last 12 months, they're up over 10% in the last 12 months. So, you hear people say, oh, yeah, people are talking good about housing. The same people that said it was a good idea to buy housing last year. Well, yeah, it was a good idea. You made 10% on your money and you're sitting with a 3% mortgage rate. What's wrong with that? It was great advice. And it is great advice to buy today, and I will show you why. Now, some people are going to try and warn you and say, well, wait a minute, Barry, look at inventory. Between April and July, inventory took a huge jump up, and that's bad. Patrick Bet-David showed this, Diana Olick showed this, and many others said, oh my gosh, look at the rise in inventory. Housing Wire worried about the rise in inventory. We said, hold on a second here. If you look at just this, I can understand. But this is 1 year. Maybe this happens every year. Can we look at maybe 10 years worth of data? You tell me if you see a pattern. Yeah, it happens every single year. Why? The reason is because as a parent, you know that if your child enters a new school because you moved in the middle of the school year, kids can be tough and cliquish and be mean. But more importantly, perhaps, is the fact that the curriculum in our country, no two teachers teach curriculum the same way or have the same agenda. They all do it differently. So your child may be an excellent student in one school, but now they go to a new school and they're completely lost. Education is building blocks. So parents don't want that. So what do they want? They want their kid to start at the beginning of the school year. So I have to be moved into my home when? June, July, or August, which means when did I have to put my old home up for sale in inventory? When? April, May, June, July. April, May, June, July. This was COVID. April, May, June, July. April, May, June, July. And you see it every single year. People that tell you there's a housing bubble. Well, can you look at 2007 when they said that there's 4 million units in inventory back then? We have 30 million more people in the United States now, 15 years later, and there's only 1.2 million units for sale. Less than a third of the units for sale, 30 million more people. But even that doesn't tell the full story, because a big chunk of these are those under contract. You can't buy a house that's under contract. They're closing next week, but it's still counted in inventory. What you want to look at is active listings. And in this country of 340 million people, there's only 750,000 active listings. Very, very little. Now, some people say, hey, it's up from last year. And it is. But last year, you had the lowest amount in history. And now it is higher by about 25% compared to a year ago. But the thing of it is, you can see it's already starting to turn. And of course, 7% mortgage rates will slow things down, right? But if you compare where we are to any other point in time, any year, we are much lower. We're half of normal levels, half of normal inventory. Uh-oh, what about foreclosures, right? Well, we're going to have a big foreclosure boom, aren't we? CBS Market Watch says dramatic increase. Foreclosure filings are up more than 150%. But that's 150% from when? From last year. Last year, you had a moratorium for most of the years. You couldn't do foreclosures. That's why you got to look at a chart. If you take out last year's ridiculously low amount because you couldn't do them, or even most of 2020 when you had moratoriums, it was even lower than that. Compare it to 2019, a normal year. Will the media say you're down 60% from them? No, they won't. Will they say you're down over 90% from the 2010 period when the housing market was in trouble? No, because that doesn't sell. Good news doesn't sell. Will they tell you that back then you had 19% equity and 81% mortgage on homes? Today you only have 42% mortgage and 58% mortgage equity. Will they tell you that? No, because good news doesn't sell. What sells? Sex sells, fear sells. So what they try and do is they feed you this fear porn. Now, another one that they just don't understand, because this is math and math is hard, is affordability. Now, I want you to think closely and carefully on this, and I want you to kind of test yourself and test your ability. Can you be a forward thinker? Can you be a critical thinker? Let's do this together. Now, a year ago, if you were buying a home and you need a $400,000 mortgage, yes, you can get a 3.5% rate, and here's your payment, $1,800. Now, what Fannie Mae does is they tell you what the average income is. So this is not a qualifying household income. Average income for an $1,800 payment was $9,000 a month. So two income earners earning about $50,000 a year. Now, this year, we know things have changed, right? Since last year, values have gone up in the last 12 months by 10%. So that means your home's 10% more expensive, so you're going to take out a 10% higher mortgage. So instead of $400, $440. But you can't get a 3.5% rate anymore. It's closer to 6.5. Okay, maybe even less than this, but let's just say 6.5. So your payment's up $1,000 from last year. And you probably, if you watch CNBC, you see Diana Olick say this 3 times a week. And it's not affordable. It's not. Yes, but it is less affordable. We understand that, but you're not talking about everything here, because income has changed too. Fortunately, we have very good data. ADP measures 25 million records of payrolls. That's 1 out of every 6 workers they are measuring. 1 out of 6. That's amazing. That's a great sample size. If you stayed at your job, you made 7.6% more. You're making 7.6% more. If you switched, you're making 15% more. More people stay than switch, so the average is 9% raise. That means your income is cut into this a lot. So it's not as bad as the media would have you think. But here's the problem too. Let's be fair. Gas costs more, food costs more, services cost more. And this is where we sit today. You've got your payment's gone up $1,200, your income's gone up $800. And that gap is why you're having some hibernation and buyers are on the sidelines. But they've already started to come back since rates have gone from 7.25, 7 3/8 down to 6.5, 6 3/8. We're starting to see them come back already because the affordability gap is narrowing. But let's be a critical thinker here. In 2023, what's going to happen? Well, we know mortgage rates will likely come down, but even if they didn't, your income, if you stay at your job, is going to go up 7.6% according to ADP. So that means that you will have already eliminated the affordability issue. In fact, get this, in 2023, you'll be more affordable than it was in 2021 when the market was on fire. And wait a second, what happens if rates do what we say they're going to do? Inflation comes down, mortgage rates come down. Then it's ridiculously more affordable. And you tell me what happens when you have a horde of buyers come out who can afford homes, who can qualify for mortgages, who want to buy those homes instead of renting in an environment where inventory is super tight. You tell me what happens. I think we all know the answer. Our housing forecast is for low single-digit appreciation. We'll continue to see that. Now, some areas, look, not all the country is going to be the same. Some areas got ahead of themselves. You know, California has a few areas like San Diego, San Francisco, Los Angeles. You've got the market in Seattle. You've got Denver, a couple of others that may come down a little bit further, may have a little bit of a longer lag time till the end of 2023. But most of the country will see single-digit appreciation. Rents are going to be up 8%. So that's no picnic either. This, ladies and gentlemen, sets up the perfect opportunity. And what is an opportunity? You know, I wrote a book about it, which is called Money in the Streets, about finding opportunity. Opportunity is because you see something that isn't obvious yet. You're able to see through all the crap, and you're able to find an opportunity before others do. Look, a $500,000 purchase price, let's just say 20% down. Last year, I had to give you $50,000 over asking price. Heck, I couldn't even get a home inspection, right? Well, now you could do something called normal, like it always has been, where you can negotiate. I can give you a little bit of a low offer. Maybe you counter, maybe I counter. Look, on a $500,000 home, not too difficult today to get a 2% discount, 2%, which is $10,000. If you only got 2%, most people would say, okay, great, I got $10,000 off the price of the home. Now that's good, but if they work with you, it's much better. Why? What I'm about to show you is something that creates more value for you and more value for your real estate agent, and why they need to work with you. Because while most people will stop here, thanks to your intelligence, you're able to take this $10,000 and create more value and turn it into a much bigger savings. How do you do that? Don't take the price discount. Use it for a permanent buy down and get points, because you can bring that rate way down. You could take that $10,000 and buy the rate down from 6.5% to 5.25%. Okay, that's great. Or you could take it and do a 2-1 buy down. That 2-1 buy down is going to give you almost the $10,000 in cost, $9,300. The balance you take towards your closing cost, that equals $10,000. Seller doesn't care. They're giving you $10,000. They don't care if it's off the price of the home or towards your closing costs and a buy down. They don't care. But now your buyer immediately gets something that they wouldn't have had. In year one, their payment's $500 a month less. Next year, when rates come down, when they refinance, they take the unused portion of the buy down. Remember, it's a buyer paid, not a lender paid buy down. And they get that refunded to them. They use that to pay for their refinance. So hold on a second, folks. You mean I get the home of my dreams today? I get it at a discount today. I get the rate that I want today. And then next year, I keep that rate or get a lower rate and the refine's paid for. And then when everybody else sees the opportunity, because it now becomes obvious that you got it on the ground floor up and prices start to go up, you paid under price while everybody else is paying over. And you enjoy those tens of thousands of dollars of profit that you made in the home. If it only goes, instead of being the discount of just 2%, if it's a profit of just 3 or 4%, you know how much money that is? You're talking $30,000, $40,000, $50,000 in a year. And you got the lower payment. That's the value that you add. And folks, you can mathematically prove to them that it's better. What if I told you it's mathematically always better to put it towards paying points and a permanent buy down or a 2-1 buy down than taking the seller discount in price? And here at MBS Highway, we got a great tool that illustrates that. For the first 3 years, the 2-1 buy down mathematically has to be cheaper on the lowest payment. Then after 3 years, the permanent buy down has to be cheaper than the lowest payment. Has to be forever. Okay, but wait a second. What if during that time you sell or refinance? You get a benefit because it was a little less down payment you put down and lower mortgage. So that has to be thought of, right? Well, that's why we show you that too. And as you can see, for the first year and a half, the 2-1 buy down is your best choice if you sell or refinance at this time. And chances are you will. Now, there is a tiny sliver of time where the price break would be slightly more beneficial than the 2-1 buy down. And that's between years 1.5 and 2.5. But after 2.5 years, if you haven't sold or refinance, that permanent buy down forever will be more valuable mathematically 100% than a price break. So if it's a 30-year loan, 97% of the time, you're better off not taking the price break and taking it in a buy down of some sort. Now, when we take a look at a buy down of some sort, why is this so important to you right now? Because it's hard to get 0-point quotes. And your customer has been either indoctrinated not to pay points, or they don't have the money to pay points. This solves that problem for you. This is the perfect opportunity in housing because incomes are going to increase, making them affordable. Inventory's tight, rates are dropping, and there's increased buyer activity, pushing prices higher. What about if they're thinking about renting? What about that? And if they're thinking about maybe renting, is it a good opportunity for them? Well, let's see. Let's take an example. Say a $400,000 home, 10% down. Now, let's even assume for a minute that the loan amount is 7%. I know it's cheaper than that, but let's make it ugly. Now, let's put all the negatives in there. Okay, so they're going to be there for 9 years, and we know that taxes on average will go up 2% a year. Not every year, but let's account for it. And we know that unlike renting, they're going to have some repair costs. Let's call it $2,000 a year or $166 a month. We'll just budget for that. And then the cost to sell, I don't have to worry about that if I'm renting. So 6% of the appreciated value, let's make that a -2. But you're going to get appreciation. On average, for the last 63 years, it's averaged 4.75% per year on average. So let's figure that in. Rent, cheap rent for that property would be $3,000 a month, and you know they're going to go up. It's going up at 8% a year, but let's only say they go up at 6%. So what's better? Is it better to buy? Is it better to rent? Well, you look at it and you say the payment to buy is $3,500, the rent it's $3,000. No brainer. So much cheaper. We should rent, right? Well, that rent goes up. Even though the taxes go up a little bit, the rent's going up faster. And when you see that by year 4, the rent's already more expensive. So over the 9 years, you could see that it cost you $33,000 less to buy than rent. It's a benefit to buy by $33,000. But wait, it's a lot more than that. Why? Because people forget that when you look at principal and interest, where does the interest go? I think that's an easy one. Everybody knows the interest goes to the lender. But where does the principal go? Where does the principal go? It's your own money. Folks, use this example. If I have cash in my left-hand pocket and I take it out and I put it in my right-hand pocket, is it still my money? Of course it is, but it is in a different location. When you're about to write your check to the lender, the principal portion of that check is sitting in your checking account. When you write the check and the lender cashes it, that principal portion of your check, where's it sitting? It's sitting in equity in your home. Is it still your money? Yes, it's just in a different location. And you have to calculate it because it's an enormous sum of money. So it is not cheaper, even initially, because when you add the principal back in, you're cheaper buying from virtually the very beginning of this loan. Now, hold on a second. What about appreciation? Well, 4.75% doesn't sound like a lot, but it is going to be compounded on that $400,000 home over 9 years. That's a hard mathematical thing to do in your head. It's hard to envision it for you, for me, for our realtor, and certainly for our customer, which is why we have to do the calculation. That's why Albert Einstein called it the 8th wonder of the world, compound interest. And when you do the calculation, it's life-changing. It's $207,000 in appreciation gain. When your customer sees this, it's so revealing. Now, you got to pay a 6% fee to sell the home probably. So let's count that on the future value of $607,000, but you are going to get a little tax benefit. So net, what's the benefit over the 9 years? $250,000. If you're there for 10 years, it's $300,000. Heck, if you're there for 5 years only, it's $90,000. So I would tell the customer in this example, I'd say, hey, listen, if you're going to move in a year and sell the home in a year, rent, don't buy. But if you're going to be there like 2 years or more, why in the world would you not buy the home? Well, I don't like the way 7% sounds. Well, do you like the way $250,000 sounds? People have to get out of their own head, and you have to be the one to illustrate. If you don't show people this, they'll never see it. And heck, help your realtor. Co-brand this with your realtor. Look, I show this to real estate agents all the time. They lose their freaking mind. And those smart ones, what they do is they take you and that realtor together and they show it on their listing appointment and say, this is how I intend to market your home. This will be in every open house. And then they go further. because what you can also provide them that we can give you is ways to grow your net worth. See, here's the thing. If you looked at net worth tiers, right? Now, what's net worth, by the way? Kiplinger's did a study. Net worth is all your assets minus all your liabilities. So when you take a look at that and you were to say, okay, what's all my assets and all my liabilities come out to by subtracting the liabilities from assets? That's my net worth. If you want to be in the top 1% in the United States, how much do you need? $10.8 million. Big number. Now, how about the top 2%? That's pretty rarefied air there. I mean, that's pretty high up there, top 2%. $2.5 million. Okay. How about the top 5%? That's a very exclusive club. The top 5% net worth needs to be $1 million. The top 10%, $800,000. And the top 50%, $500,000. So you want to be in the top half. That's what you need. But here's the best thing that came out of the Kiplinger study is that on average, 2/3 of all net worth came from, yeah, you guessed it, home equity. You're not going to get rich being a renter. You have to be in the real estate game. And that's why so many people are looking at investment property. Investment properties make up 1 out of every 6 transactions. Are you getting your fair share? Is your real estate agent? The reason why a lot of people don't do a lot of investment properties because they don't have a tool that can help them analyze it for their customers and show them. There isn't one until we created one at MBS Highway. And I want to show it to you because it's very compelling. Watch this. Let's say there's a purchase price of $500,000, 25% down to $375 mortgage. Let's say the 30-year fixed rate is 7% with 1 point for an investor. They're going to own this home for 10 years. Let's figure the cost to buy, the repair costs, property tax increases, cost to sell, and for the next 10 years, the forecasted appreciation is 5.4%. So let's factor that in. Now, rents are going up at 8%, but let's say they only go up at 6%. And right now, on a $500,000 home, you could rent that thing very cheap at $3,500. So let's be conservative. Vacancies in the United States are 4%. So let's put a vacancy factor in there too, to be fair. Now, in the first year, you'll lose some money, but by the 10th year, you're going to make lots of money. And in fact, on cash, you're going to make 54%. And when you look at the real money, it's going to come from appreciation and amortization. So here's your ledger. Rental income, $531,000 after your vacancies contemplated, plus appreciation. Gross revenues, $883,000. Minus expenses for interest, property taxes, insurance, repairs, and the cost to buy and sell. And you've got a $415,000 profit. You invested $125,000. So your return on investment's 332%. That's an average compounded annual return of 15.8%. Why would a realtor not bring this to every single prospective listing appointment to show how they're going to market it and have it at every single open house with your picture on it? And by the way, why wouldn't they have an AVM? You don't want to go to Zillow because then they'll hawk your customers and try and steal them from the realtor and from you and sell them to their mortgage company. This is a great tool. Have an appraisal. It takes 3 seconds to pull any of these things up in MBS Highway, so use it. And this is, you can co-brand it with the realtor. The realtor brings this to the listing appointment, shows the whole neighborhood, how many bedrooms, what the values are, what the value of the home is, so they know what they're pricing it at. And then where are all the comps? Do all the work for the realtor so they don't have to spend an hour doing all the comps. And then all the trends in the market. Make a professional presentation. Have it at every open house and every listing presentation. And one more is the real estate report card. This is what people want. What has it been like for the last 63 years on this home, the last 10 years, the last 5 years? What's the forecast for the next 1 and 5 years? How much money will somebody make if they buy this home? How many households are being formed? How many homes are being built? What's going on with population? What's the demographics, renters, unemployment, incomes, affordability, jobs, everything you want to know on one beautiful report that you co-brand with your realtor. Team, people ask me all the time, Barry, you know what? It would be so great if my realtor had you at an appointment like that with a customer, either for a listing or a purchase, because they'd sell every single one and I'd sell every single one. So we just created something that allows you to talk the same way. It's called Certified Mortgage Advisor. It's normally $2,000. It's an 8-hour course, 20-minute intervals. It's a test. It is life-changing. Everyone who's gone through it can't believe it. Instead of $2,000, you get $400 off today if you just email Dan at MBS Highway, who's on this. Just email Dan at MBS Highway. Now, if you're not on MBS Highway, why? Why? Every day, the update that we give you in 7 or 8 minutes is life-changing. It will give you scripts and you will sound more educated than your competition. Heck, I'd worry if your competition had it and if you don't, because they're going to sound a lot better to that customer, and that's how you win. We'll alert you when the market's changing. We'll tell you what's about to happen. We'll break down everything for you in a usable format so you can be an advisor instead of a salesperson. And all the tools you saw are included there. Now, normally it's $200 a month or $2,000 a year. It's cheap at that. We got 35,000 people on it paying it. But today, if you signed up by emailing Dan at MBS Highway, your discount is 40% off. So you get a ridiculous price of, it comes out to what? Less than $4 a day. What if you lost the deal? The $4 seems like a pretty foolish thing not to do. So Dan at MBS Highway, if you want to do both, email Dan at MBS Highway and you save even more money. It's like half price, 50% reduction in price if you get both. It's a great deal if you do that today. There's an amazing opportunity, as I said, in housing today. So John Templeton, one of the greatest investors in the world. I know people like Warren Buffett, but he said the same thing. Warren Buffett said, be greedy when others are fearful. There's a lot of fear, so now's the time to be greedy. John Templeton said the time of maximum pessimism is the best time to buy. You see all that pessimism, now's the time to buy. And by the way, hope that you enjoyed today's talk. Many of you helped me make Money in the Streets a #1 bestseller by purchasing the book. Hopefully you enjoy it. And if you want to stay in touch with me, you can do so by just scanning this QR code or looking me up on Instagram.